Welcome to FinFactor. I'm your host, Blaine Bertsch, co-founder and CEO at Dry Run Cash Flow Forecasting Software, where we help the office of the CFO leave spreadsheets behind and model everything from cash flow through to complex scenarios with clarity and control. And joining me today is Holli Moeini. Holli is a 35-year CPA that focuses on M&A. And today, we'll explore how CFOs can move beyond basic EBITDA analysis to identify the subtle operational details and human judgments that either secure or destroy millions of value in the final stages of an acquisition. Welcome to the show, Holli.
Thank you so much for having me, Blaine. I'm happy to be here, happy to talk to you and the audience today. I'm with a bunch of CFOs who I adore and love nothing other than to speak to.
And of course, we talk with CFOs every day, and it's amazing how often M&A comes up, even if they're not even there yet, or they start to get an inkling. CEO starts talking about it, and they start going, "Oh, okay, we better be ready just in case." So let's dive in first. Like, what are some of the issues that you see businesses struggling with before they actually dive into this process?
Yeah, so I want to address the first thing you said first. And whether you are in a company that the CEO comes to you and says, we want to buy a company, or whether you are with a company that people are knocking on your doors. And why is that happening? It's like there's $4 trillion in private equity, and they're trying to deploy capital. And then you have a bunch of new buyers in the system that want to do a buy and build strategy where they're buying up smaller companies, put it for a lower multiple of earnings, and then putting them together and selling them. So you've got so much activity. So your CEO probably gets these calls like, are you ready to sell? Are you ready to sell? And depending on what kind of a day it is, you might get that call saying, yeah, we want to sell. So foundationally, it's going to happen for our people. Our CFOs have to be ready. And so just from that point to going to the next point is, like you had said that I've been a CPA for over 35 years. I worked in public accounting for almost, I say 10, but it was really 9 years as an auditor, not tax, but audit. And I was a great auditor. I knew GAAP. I knew all those things, but I did not know how to prepare a company to sell. I had no idea. And I really didn't know. I know how to audit a company, but did I know how to do due diligence? So not until I left public accounting and I went to work and I grew and scaled companies. And one of our strategies was buying for strategic growth along with our organic growth. And I was in charge of that. And so I had an investment banker that actually taught me from the very beginning all the things you have to do to get ready. And so that's kind of how I learned it. My whole entire world was then bringing in new businesses. So through acquisition and integrating them. So every aspect of it. So when you look at businesses, the stats out there are something like 70% are not ready. And then the ones that do go out to market, only like 20 to 30% sell. So that means 70 to 80% don't sell. Why is that? And there's a variety of factors. So if we go in and we look at how us as a CFO can come in and be a different statistic, because on the buy side, 70 to 90% of the buyers say they did not get the deal value they thought they were going to get. So everybody's losing. Blaine, why is everybody losing? It's like and there's so much activity and so much excitement around it. And so when I hung up my shingle and started helping the SMB market, I was like, okay, I'm seeing some of what I'm going to call the M&A crime scenes. And, the first story of the crime scene is that if you're going to go out to market, and I see this all the time on the buy side, I'm receiving financials from sellers and they give you your tax returns. They give you internal books that have not been maximized for value. So your financial story is the first part of the problem. And again, like you guys all know this because you're accountants, that when you are growing and you sell at a growth stage and you're on a cash basis, you have the worst EBITDA, and that's earnings before interest, taxes, depreciation, amortization. You guys probably all know that. But like, so you have the worst there versus if you just switch to accrual, you're millions of dollars worth more in value because you take that EBITDA. Most businesses are sold on a multiple of EBITDA. So you take that EBITDA and you change it, $100,000, times 10, that's $1 million. So
Yeah.
it's a real thing. And our CFOs, I know, are aware of that. But one of the other things is that we go back, your buyer will go back 3 years. So you have to tell a story over 3 years. And then you want to look over that period of time. And I would tell all of our CFOs, if you have an inkling that might happen, I like to plan 3 to 5 years because it's more than just your financial story. We'll get to that. If you're planning out 3 years, you need to make sure you normalize EBITDA. That means add backs, all the add backs. And so personal expenses. If you hired a fractional CFO, you don't need that. Conferences, the things that I would go more on the aggressive side of add backs. And I do hear comments about private equity not liking ad backs, but I've never been denied an ad back because you have to do it right, tell the story, and it's right. So really scraping for all of those ad backs to get a normalized, what I'm going to call an adjusted and a normalized EBITDA, just not just by definition, right? So
Mhm.
that's the first crime scene. So you go and when you're selling a company, the first phase, like if you get somebody on the line and you sign a letter of intent, you go to due diligence. That is where most of the deals are killed. Why is that? Because your financial story doesn't hold up. So get GAAP records. Make sure that story holds up under scrutiny. Under an audit, you got to think in terms of audit. And if you've never been through an audit before, you need to make sure that the CEO is saying the same words. Because what happens is there's a multiple of what you could sell for, let's say 8 to 10 times. So you want what gets you closer to the 10 and not by the 8. And so
Yeah.
it's trust, right? So and what's the lift going to be after I buy you? So if your financial records look tight, everything reconciles, you go into diligence, you sail through diligence, EBITDA maintains or holds its place within a reasonable amount. I'm getting more trust in you. So that multiple is climbing. So like that's the first kind of crime scene that starts in the very beginning. And for the buyers, that crime scene starts because as a buyer, you get excited. You found somebody you've been looking for a long time, and they rush in without looking at the balance sheet and the income statement, and they look at the broker's marketing materials, what I call it, the SIM, the confidential
Mhm.
information memorandum. I call that marketing. And looking at that EBITDA going, yay. And you as a buyer, you need to rebuild that and ask questions. But buyers rush into an LOI. And so
Mm.
what happens with that is an LOI, letter of intent, is non-binding, but trust starts happening between you and the seller. The buyer and seller start having trust at that point in time. And if you start retrading those items because of information you find, that trust starts eroding. The deal starts getting precarious. And so
Mm.
private equity, sophisticated buyers, they don't rush into an LOI. They ask the questions. They'll try you out forever, and then they'll come with a really good LOI. So from a buy side, that's what you want to do. So like that's the very first crime scene that happens, and we don't have to go through all 5 of them. But the one that I think the accountants might like the most is working capital. So working capital is a crime scene because sellers and brokers tell them this, and sometimes they've bought a company and they were not delivered any working capital. And I don't have to explain what that is to you guys, but usually in the definition of M&A, you exclude cash unless you need to have it in there. So usually
Mm.
you are buying something that is cash-free, debt-free. So the owner walks away with your check, the cash in the business, and pays the debt of the business, and everybody moves along in an asset purchase agreement if it's a stock agreement, but most of them are asset purchase agreements. So for working capital, what happens is you set a price as a seller and you think I made that AAR, it's mine. Okay, I'm taking that with me. And sophisticated buyers come in and they demand for a market multiple that you give some working capital. So sellers, if you don't set that up front into your price, you're going to be taking a haircut and you're going to be mad. So a lot of my deals fall apart on working capital. And buyers come in and they don't educate, they just put some fancy fluffy language in. That's really, I mean, it's not the best, but they usually say 3 months of average historical working capital. Like, what the heck is that? What if your average is too high? And the buyer doesn't need it. So working capital should be delivered as a neutral component. It should not be something that is a gain for the buyer, and it shouldn't be a haircut for the seller. But you have to think about that before people go in. And the thing about that, and I buy and sell a lot of accounting firms right now. And the thing about that is nobody agrees on what that number is, Blaine.
Yeah.
So you get a bunch of accountants in the room, even we can't agree. We at least understand it. The others, it's really difficult. But that becomes a crime scene, and I've seen deals fall apart because of that. So, yeah.
Yeah, sorry, go ahead. I
No,
was
go ahead.
just really interesting.
Absolutely. Mhm.
Well, I think what's I find like quite fascinating is like from my point of view, we deal, of course, with businesses on the operational side, and
Yeah.
we know it's a benefit for them to know what's happening in their cash flow to be able to sell them properly and everything. But all things you're talking about, it feels to me like, yeah, if you need 3 to 5 years of track record, it's kind of best case scenario for that. Also, it's just better for the business. Like if during that 3 to 5 years, if you don't exit, you're going to have more profit at the end of the day. You're going to have a much healthier business. So to me, it's the prep for M&A. It's a philosophy also that seems like prep for acquisition is also a great way to make sure that your business is literally just running maybe better than it historically has, and it's all benefit. There's no downside to running the business properly.
I really agree, and I'm glad you brought up cash flow. I love this synergy between us because a company that has actually looked at their cash flow, have systems and process in place, and then can deliver that during diligence rises above everybody else. It just does. And I look at this, and I said this when I wrote my book, which is finding the missing millions in M&A. When I wrote that, I had said in the book I wrote, I've never received a cash flow statement in my package as a buyer. And then finally I
Mhm.
got one, but it was from a CPA firm. So I don't think that counts. Okay. But for everybody out there that's listening, that's a really important part about how do you look better to buyers? And I can't overemphasize enough your financial records being tight, having cash flow planning, having your cash flow statement, understanding all of that, having this history so you can show the hero's journey of your company's records is really super important. So I'm glad you brought that up. And I've seen it like, and if I can just talk about, we'll go down the path of cash flow planning because you love it and I love it. So it is one thing that we both love. I was going to do a financial assessment for a new company, had me just come in to see what they could fix. And I started looking at things. I thought, oh, they have a cash flow. They're going to have they have a cash flow problem. They didn't have a cash flow statement. I recreated it because I was like, what's going on with all the money? So if it's a big company, it's hard to figure that out. And it was
Mhm.
kind of quasi accrual. A lot of companies are in the middle, right? They're not really full GAAP and they're not really cash. It's kind of in the middle. And somebody didn't have controls on inventory. They bought so much inventory, they had 2 to 3 years worth of inventory, and they had no more
Mhm.
cash. And I
Yeah.
and everybody's like, "Well, how did we get here?" And so I started working with their CFO, and I said, "First of all, you don't have any cash flow forecasting, and the second thing is you could see this on your balance sheet and your cash flow statement. You can see the problem. Like you can see that inventory keeps increasing." Never goes down. You can see
Yeah.
AR too, what's happening with AR. And so I always say to all of our CFOs out there, and this is how I look at things, this is how quality of earnings, private equity CPAs look at things, is I look at everything as a trend. And I'm sure your software looks at everything as a trend too, right? So I look month over month over month, and I don't spend a great deal of time, but you can see month over month they could have spotted their problem the second month in, and they would have been millions of dollars ahead. And so if I know my CEOs, I worked with a lot of CEOs, and none of them wanted to look at the cash flow statement. And so it's really not about them. It's about you managing the company and making sure that no company has perfect internal controls, right? Something will go haywire. And so having that purview is really important. So yeah, I think we share that that alignment around cash flow planning and cash flow.
Well, and we see businesses that, again, sometimes it shocks me how big the businesses are. How did you grow to be 75 million, 125 million, and have this big of a problem? Like, and it's
Yeah,
this blind spot that they a lot of times the C-suite doesn't realize, or they might kind of go, something isn't quite adding up here, but they don't have the insight. They don't have the data. They don't understand that, okay, we got some broken parts here because their cash flow forecast can give them, it's not just timing of inflows and outflows. It's also sometimes reading the tea leaves and going, this doesn't make sense here. This is broken, right? And those are the types of things that, again, over time will in, continue to add value to your business for an acquisition and give them, like you
for
said,
sure.
trust. They want to be
Yeah.
able to trust what they're buying is ticking along and working really well.
For sure, and I'm just gonna, like, fall on my sword here that, I when I left public accounting, I went to work for my first company, we actually sold it, um, 5 years later, and I will say, and I'm, of course, a trained CPA accountant from a public accounting firm, I didn't do an internal. I mean, we did the cash flow statement, nobody looked at it, and I didn't trend things, and I was hindered at the time. Of course, this is several years ago, we shouldn't be hindered today. I was hindered at the time of not having a report to be able to see things clearly, and so I didn't look at it, and if my I tried to outpace my CEO with operational reports and things that they would know, and we had, unless we had problems with cash, we didn't look at it, and I fell short, I think, in my early days, and I grew that from, I don't know, I think I came there at 40, 50 million. We sold at 200 million about. And then another company I came in a little bit, they were a little bit bigger, 60 million. And we went to 200 million, but we did not look strongly at cash flow because we had a lot of cash, that's still not a reason to do it because there are so many components that you see outside of just the cash number in a cash flow statement. So, and
Yeah.
my crusade is that I want every CEO and to look at the cash flow, or to look at the balance sheet and then the cash flow statement. So I want to bring them back into the boardroom to look at, so that folks can make better decisions. And I think that our people, our CFOs, are the people that can, when they tell a story instead of just looking at numbers, like, to me, the financial statements tell a story, and that story, I always say it and they laugh at me, the CEOs laugh at me. I say, "It is a love story." And they're like, "What?" I go, "This is about romance." They're like, "What?" So in front of 600 CEOs, I asked, "Who reviews their P&L?" Everybody's hand went up. And then I said, "Who reviews their balance sheet?" Not one CEO had their hand raised up, not one. And
Yeah.
there was one
Sure.
accountant that raised her hand, and I knew who she was in the sea of 600 people. And so when I say it's a romance, what I mean by that is they never leave each other's side. That the P&L might tell the story, but that these secrets and everything exists on the balance sheet forever. And so how can you look
Mhm.
at one without the other? And if your balance sheet is wrong, our accountants know this, your P&L is wrong, our founders, our CEOs do not know this. And so I try to make it interesting for them to tell them the story. And this is the reason why you want to spend 15 minutes. I mean, listen, you don't have to spend a lot of time looking at everything, but there should be, some sort of review, monthly review, at least the minimum of that with the cash flow forecast. It's super important.
Well, and like, there's been, like we've seen over the last number of years, really since kind of COVID hit, for what we see in our business is just this much higher level of volatility, much higher level of uh, unknowns. Just unknown unknowns, right?
Yes.
It gets so complicated and so complex, and if businesses are only looking in the past, it can be so misleading because and the canary in the coal mine is generally the cash flow forecast. And we're always talking about cash flow, cash flow, cash flow. Truthfully, dry run goes beyond that, and you're scenario modeling.
Yeah,
You're
yeah,
actually
yeah.
forecasting revenue and probabilities on closing deals, whatever you want to do. But we still view it as this foundational. It brings realism to it when you're talking about cash flow. It's like this is what drives the business forward. It's what pays the bills. It's what helps you expand and grow the business. And of course, it's what helps build value in the business. That's easy to spot and easy to see. So, what are some of the key areas that you think are getting missed today? Like that a CEO should be kind of going, okay, yeah, we got like the checklist of some of these things are looking pretty good, but what are some of the really common gaps that you find them missing that are really affecting their value in the end?
Yeah. Okay. So I do want to just speak quickly to the cash flow. So I was on a podcast where they asked me like, well, revenue, and I said, yeah, I don't care about revenue. I care about cash flow. And so, that was like blasphemous, right? Like that you should not care, that you don't care about revenue. I said, well, I'll backtrack that a little bit. I actually do care about cash flow more because your enterprise value is based on cash flow, not on revenue. You
Mm,
can grow your revenue out and you can grow yourself into bankruptcy because you're not
yeah.
profitable. So I think every year as a CFO, and I have templates like from my book, and if you got a hold of me, I'd give them to you for free. But where you every year with your budget, you look at it's called a value creation plan. And it takes your revenue and it takes your EBITDA, your earnings, and it bridges it to the next year and says, what are you going to do? You're going to change price. So it kind of gives you all the levers of increasing. And at the end, so like from 25 to 26, you can see how much revenue is growing compared to your EBITDA. And you better have that EBITDA growing bigger. So that means you got to do
Mm,
margin improvement. That means so it's a real good focus opportunity. So I could talk about cash flow all day long with you, but yes, there are other metrics you should look at, but cash flow really matters. And so let's go back to your question. Then you said like, what are some of the things that CEOs are actually missing? So that will improve that valuation, right? So the one of the first things is that they are the business. So if it's a
mm,
lifestyle business, you being the business, that is either not transactable or a lower multiple. So you have to have leadership and depth in your bench, and
mhm,
that will provide more value. What's very very important in the market right now. And I'm not saying project based revenue isn't transacted, it is, but the higher multiple is for memberships for reoccurring revenue. That's why
mm,
it's very popular right now to buy accounting firms with subscription revenue instead of like seasonal revenue. So that's
mhm,
really super important. And then technology, you're part of that technology, right? Technology, data, marketing, all of those things, having SOPs and processes. Because if you think about a buyer's looking and assessing you compared to other people, they have other businesses that they can buy. And they're
yeah.
saying, what is that lift going to look like after close? And the
Mhm,
tighter your operations are, the higher your multiple is because that risk looks a lot lower. And so the quality of your operations, all of those things are really important. The quality of your revenue. If you have a big concentration, then should be some initiatives around your strategic plan to reduce that concentration. So all of those things are really important. Of course, the quality of the financial statements. So I see that CEOs kind of get that wrong. They think it's blood, sweat, and tears that actually transacts value, and that's actually we heard it in the statistics that does not happen. And so
mhm,
your CFO, the other thing that I think is really important for our crowd here is that the CFO is really more than just the CFO in an M&A transaction. So for you got to be along the whole time. And where a lot of value leaks is at closing and at integration. And the CFO, when I was doing all my buying as a CFO in a business, I went with the CEO for the whole entire time. Operations wasn't there; I was there. But you
mhm,
got to think about like integration starts. in the first conversations. You figure out who's the key player that we need to nail down before closing.
Mhm.
There's all kinds of things they say that leak out in conversations when you're
Right.
breaking bread or whatever you're doing with them that informs the integration plan at the end. And so CFOs, you have a big role to play, whether you're buying or whether you're selling. You should be along for the ride. And I'll give you another example because what's hot right now are earnouts. So whether you're on the buy side or the sell side, it doesn't matter. What I'm going to say is going to be important for both sides. That is one of the crime scenes I see. And I love earnouts. People don't like them. They're out in the marketplace saying they're horrible. I love them because it bridges the gap of value. Sometimes you, as a seller, think you're one thing, buyer thinks it's another thing, or you're growing and you want to sell, but you don't want to have them get the full upswing. You bake in an earnout. It's very common right now. That's a trend that it kind of comes in and comes out with the tides. Right now it's in with the tides. So
Yeah.
so right now, what happens is I had a client was private equity was buying them, and his earnout was based on net revenue. Okay, everybody thinks great, net revenue. Fine, that's easy. So net of what? Net of bad debts. Okay, that's easy. And historical practices and GAAP. And so
Mhm.
we're like, okay, I say, oh, no, 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 no. And so I was along for the ride. So CFOs, you have to be along with your legal partner. Always get an M&A attorney if you can. Sometimes if the seller brings uneducated attorney, it's an issue. Sometimes they kill the deal. But
Mhm.
so bring them in. So your attorney needs a business partner. So the attorney was like, okay, that sounds fine. And I'm like, okay, no. And the seller who was my client, he said, do we need to make a big deal about this? I'm like, oh, yes, we do. I said, bad debts as CPAs, as accountants, we know that can be any definition. That is wide as the day is long. Okay. Like,
Mhm.
so I said, no, 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 we're going to so we did a paragraph about yay big, very, very big paragraph that said, if we're still trying to collect it, it doesn't count, like blah, blah, blah. And the seller was like, all right, Holly, you do your thing. I feel protected, but okay. He was kind of thinking like I went a little crazy. 4 months after he sold, the accountants came in for the private equity that they sold to and said, oh, we're writing off everything at 90 days, 50% at 90 days. They took a very aggressive policy. Let's just put it that way, very aggressive. And these people were dealt with insurance. So there's a approval process and then so it lengthens the cash cycle. And so most of their
Mhm.
stuff was going to be written off. And I said, well, I actually like their accountants. They're being very conservative. I think that's very good. But thank God you're not held to their procedures. And so one of the things that I always say is make things really clear in the earnout, like so clear.
Mhm.
Make sure in the document you don't wait for later that the seller has control over the elements of the earnout, or things will go
Mhm.
wrong. So if it's revenue, he or she has to have control over the revenue process, and it has to be clear. And then you have to have some cadence. So I said, well, we're not waiting. It was 4 months in. It's a 12-month earnout. I go, we're going to get them on the horn right now and say, this is what we assume. Your accountants, which is good, they have a different policy. We don't adhere to that policy. They said, yes, you're right. So I don't like any surprise at the end. So you have to manage the earnout. So as a business partner, because that's what you are as a CFO, you walk with them every step of the way. They should never be alone. The CEO should never go it alone, not one meeting, not one anything. And so
Yeah.
you're the natural partner for them when you're buying and or selling.
So, we could talk for probably hours on this because there's so much to cover. And I know you talked about like some like 5 crime scenes. I think we covered one or two maybe. Um, but there's a lot there. So I want to make sure that people know who should be talking with you. When should they be approaching you? And I also want to encourage everyone to. I know you mentioned a book. I'm guessing that probably has all the crime scenes in it. Also, tell us a little bit about that book because I want to make sure that people can also track that down.
Yeah, thank you. So it's called Finding the Missing Millions in M&A, and you can find it in Amazon, Barnes& and Noble, all the places. I don't call them crime scenes in there, but I walk you through a linear fashion, more of a analytical linear fashion, but a fun fashion I have all kinds of stories. The romance is in there, secrets, dead bodies, all of that is in your financial story. So it's a fun book, but it will tell you where it will show you how to make sure you are not falling prey to any of the crime scenes for the buyer and for the seller. So it doesn't matter what side you're on, it will tell you. So I appreciate you letting me talk a little bit about that. And I have touched upon many of them. I think that I wrote the book because I saw people struggling that's still, if you've done one or two, you still don't know until you've done a bunch of them. Like there's always new things coming up. And
Mhm.
so I wrote them because people that I saw that are smart people just struggle with this. You can't know. It's a very emotional. It's emotional. It is people. It's human. It's HR. It's legal. It's financial. It takes and it's like your life's work all rolled into one day. And it's a big deal. So you
Mhm.
are a therapist, you are all these things. And so as our CFO, I think that everybody would benefit from reading that book because you are the therapist, you're the financial person, you are the one who's going to make sure that you're not moving risks. I think in a deal, risk starts moving, and we like that as CFOs. We don't want the risk, right? So risk starts moving before you even realize it. So I was like,
Mhm.
why does that happen and sneak up on people? And it's because you don't know the whole terrain. And I was like, I'm going to write a book that goes through the whole terrain and,
Mhm.
make a map where you're going to lose things. And so getting back to your point of when should they be looking? So you should be if you're looking out 12 months to get ready, that's a tight time frame. It can be done,
Mhm.
but it's tight. So I would say 3 to 5 years out. But anytime that you find yourself in a situation, it's best to know we got to maximize first. If you're on the sell side, on the buy side, I, I would just say for the buyers, what I see a lot is they don't come enough to the CFO. So if you have a CEO that is like, I'm going to buy this person and you get stuck at the end, I see that a lot. And then they're
Mhm.
stuck at the end of the dragon, okay? And the dragon is going making all these deals and ruining the risk and the books are a mess and you don't get the agreement to record it properly. This is the kind of stuff I see. Club them over
Mhm.
the head and read my book and tell them how they're missing out. Club them over the head because what I do see is that oftentimes they buy cash flow that doesn't support the debt that they're getting on them. So you got to figure out
Mhm.
like, do you have enough debt? And I have all that in the book of what I think is the optimum. And so I think like we are really important for our businesses to be successful, whether it's cash flow planning, whether it's M&A. We should walk the line with them and show them why we need to be with them as CEOs to save them, save the company, and from risk, and then make millions more because you don't
Mhm.
know you're losing the millions. And
Yeah.
my clients, I've had more than one client say, "Holly, I wouldn't have known that. They just took $1 million from me. It was private equity. They're sneaky." Okay. And he goes, "I wouldn't have known that." And I'm like, "Yeah." And so like they need you. So
Yeah.
that's my call out. CFOs, your CEO needs you.
Yeah, absolutely. And they also need you. How can they get hold of you if they want to talk with you and they're in a position to sell, buy, whatever? Who should reach out to you and how should they get hold of you?
Anybody can reach out to me. I mean, I'm small to medium sized businesses, and so up to 50 million. I work with, and so my website. You can get a hold of me on my website, in LinkedIn, Holli Moeini. So there's a lot of I's, there's a lot of vowels there, but I am on both. And just reach out to me. I will get back to you.
Terrific, and I'll make sure that that gets into the show notes. So just look
Thank
below,
you.
and you can find everything in there. And if you are a CFO, especially, or leading a finance team, you guys are still buried in spreadsheets to understand what's happening in your cash flow. Uh, Come and see us at Dry Run. We're going to save you a ton of time. We're going to give you something that makes perfect sense to the management team, and make sure that you guys are prepared to hopefully sell the business down the road as well. Come visit us at dryrun.com. Thanks again, Holly, so much. I really appreciate the time.
Thanks for having me.